Good day, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. It's about 8:06 in the morning. The market's going to gear up to open up in about an hour and 24 minutes to be specific with you. And today is the 6th of January. It's Friday. It's the last day of the first week of the year. And as you can see here, and by the way, before we get deep into this, and I'll kind of remind you of this as we go through this analysis, but remember something. The week before Christmas starts and the week after New Year's, that period is a holiday period. This is what I showed you yesterday. The market is still in this range. It's been in this range since the 15th of December, about a week before the holiday started, and I'm expecting this to be the last week or the last period before next week. Next week is the real start of the stock market. Next week is when all the hedge fund managers get back and all the traders get back. This week is kind of like amateurish week. A lot of people are still getting back. My wife is coming back from Colorado. She's with my daughter there. But the point is, the algos, which dominate Wall Street, they trade about 80% of the time. They feed off of consumer demand and supply of stocks. In other words, the algos can't generate volume on their own. They need something to go against. So what happens is this: when you have all these algorithms trying to find inefficiencies, right? Follow along here. And you have a market that's barely moving anywhere. It allows basically the algos don't have anything to work with. It's kind of like imagine you feed an animal something, and if you feed it something that has a lot of caffeine, it'll go crazy. And if you feed it something with rice, or a child, right? Forget animals. Children with rice or something calming, they'll go to sleep. Well, the algos over-exaggerate both directional and non-directional. So when volatility and trading action from retail traders gets really wound up, the algos have something to work with. It's basically kind of like fire for the wood. Without fire, the wood can't do much, right? So right now, consumers are very, very. They're coming back from holidays. They're disoriented. They're still just focus. They're just now starting to focus on the financials, and the algos have had nothing to do. And when algos have nothing to do, they basically consolidate and they go real quiet. And that's what you're seeing right here. So algos, you should look at algos as a catalyst for what people do. So if people get really active, the algos get really active. If the retail investor gets really calm and there's nothing to trade against, the algos have nothing to do and their range and volatility gets really quiet. Next week, I'm expecting the algos to start moving, and therefore I'm expecting these levels to be broken. So let me give you these levels on the SPY. These are really important levels because once we break these levels, there's no turning back. On the Dow Jones, that level is about 30, and it's right by the 200-day moving average, I should say, too, and I'm not expecting us to break it very much. So in my opinion, I would say about 33,500. If we're above 33,500, there's a good chance the algos are buying. But if we drop below 32,500, it's only about a 2,000 point range here. If we drop below 32,500, this market is toast. Now look at the QQQ. I want to make sure you have these levels because they're going to be broken either today or next week. I'm almost certain of it. I can't guarantee you anything, but I'm almost certain of it. And I think they're going to break down if you want to know my 5 cents. But again, I can't, I don't want to predict anything. So as you can see here, that's the NASDAQ 100, and we're already kind of near the low end of the range. Now, we could turn around and go up, or we can come down. But on the NASDAQ 100, that range is about 260 to about 270. It's not that high. It's like 5%, maybe even 2.5%. Very, very little. And finally, on the SPY, which is the one I would really be focused on, that level is, just bring it down here, it's about 3870 or 387. I'm just taking the zero off. Or to the bottom side, 375 or 3750. So my point here is we're very consolidating. We're very, very choppy. There's just not a lot of directional bias. And when that happens, the algos don't give us sustained moves. They don't give us, in other words, volatility only lasts a day or two before turning around. Let me go back to daily charts so you could see what I'm talking about. That's intraday, but this is daily. See that? That's algo trading right now. So you got to be very, very careful, because when you see this type of volatility contracting, it's because algos have nothing to trade against. And when they have nothing to trade against, it's like they're on 30% capacity instead of 120% capacity. I'm being facetious, but you know what I'm saying. So expect us to break out of this range right here, because till we do, you're going to see 1-2 days up, 1-2 days down, 1-2 days up, 1-2 days down. It's not enough to give us some sustainable profit or even loss. It's just choppiness, which causes options to decay. Well, you can thank algos for that. So whenever you see something like that, understand it's because algos don't have anything to work with. Now, the market is down today. I wanted to give you a little algo lesson. And by the way, if you like these little tidbits while I'm doing my analysis, post in the YouTube Wealth Press channel, comment, and I'll respond. I want to make sure you guys are getting some value out of these videos. All right, now, the Nasdaq's already down about 30 points. The Dow is up about 5 points, and the S&P is down. And this is telling us that we're all waiting for the jobless report or the employment situation. Now, the non-farm payroll, this is going to be a situation where last time the number was really, really strong, really strong, and unemployment was only 3.7%. That's the squirrely thing about this recessionary environment. Employment rate is good because this is not a regular recession. This is something new. And you've got non-farm payroll. Look at the consensus, 150,000 to 230,000. They have no idea what's going to happen. But if the number's really, really good, you know what the Fed's going to say? Hey, we've got a lot more to work with. We can be a little more aggressive in taming this inflation. So it's one of those things where better employment is worse for the economy. Worse employment is better, because then they'll say, hey, we got to take it easy. We don't want to shake people out of jobs. I'm looking at the unemployment rate. I think this unemployment rate is the most important thing, but keep an eye on this number. It's coming out in 20 minutes, less than 20 minutes. So let me talk a little bit about pre-market open, and then I'll get into the nitty gritty. So yesterday, stronger than expected U.S. labor market stoked investors' fear that the Federal Reserve would remain aggressive. And that's kind of what I just said. We had the private ADP report. This is where good data is negative for the market and soft data is positive for the market. So ADP National Employment Report yesterday showed 235,000 jobs compared to expectation of 150,000 jobs. You see what I'm saying? At the same time, the Labor Department reported claims for state unemployment benefits dropped to a 3.5-month low of 204,000. And remember, take it easy. Don't get so wound up. That's a private report, and a lot of times it's really off, especially lately. So let's see what the real number comes out. But this is the biggest financial report of the month. Kansas City Fed president and Atlanta Fed president said Thursday that the Fed's priority was to curb inflation through policy tightening. Like we didn't know that. However, Bullard, God bless this guy, said 2023 could bring some welcome relief on the inflation front. I think so too, but towards the end of the year. Now, here's where things get really squirrely. I go through this with you every day. Remember I said to you the other day, 0.25 was at 75% when we started this exercise after the last Fed meeting, and about 30% of the 50 basis point. Look at this now, 57 versus 42. And if we keep getting data like that, strong data, this number will go to 50%. And if it goes to 50%, that's going to underestimate, or it's going to underestimate, or it's going to be a big standout in light of what the Fed's expectation was baked into the market at 0.25. So it's really going to change some numbers, because it's not what the market is guessing right now. It's going to basically second guess what the Fed is doing right now. And if this number keeps going higher, it's not good for the stock market. Today, all eyes are on the non-farm payroll. That's what I was talking about. They're saying 200,000 compared to 263,000. If the number's weak, really, really weak, which I don't think it's going to be bullish for the market. If the number's really strong, it's going to be bearish for the market. Unemployment, however, is at 3.7%. U.S. factory orders are coming out today. They're looking at a month-over-month of negative 0.8% compared to 1%. Nothing really big there. The unemployment data is going to be the big one. In Europe, stocks were up slightly, expecting or actually looking to see what U.S. is going to do and digesting a bigger than expected drop in the Eurozone inflation data. That's really, really good ahead of the jobless report. If that continues, they may get a rally next week. China closed higher as the country prepares to open its borders after 3 years of COVID lockdowns. I can't even believe I'm reading that. However, China is still grappling with a massive surge in COVID. Well, we could see how those anti-COVID restrictions have been really helping. Don't get me started. Earnings, and stocks to watch. Costco keeps on ticking. Rose about 2% in pre-market trading after they reported $23 billion. That's up 7%. And I was telling Matt the other day that I think Costco's going to keep doing well, even though they have memberships, because people go bargain shopping at Costco. They buy quantity. It's just a natural thing. My dad has a membership. I asked him to buy me razor blades there. So we're still using it even though we're not members anymore. We used to when the kids were little, when we had a lot of diapers and things like that, but our youngest now is 9 years old, so those days are gone. Also, keep your eye on World Wrestling Entertainment, where Vince McMahon made a news that he may be returning, which gained 10% for the company. There are no major earnings today. Costco was the real big one yesterday, and that did well, but the Fed data did not do anything to keep the market happy. Bonds. I'm hoping that the bonds can go a little higher, but I don't think that's going to happen if the employment report is very, very positive. I think bonds are going to go lower, but I'm hoping they'll go higher because if they do, we'll have a chance to sell them. I want to sell them again at the 108 level, the TLT. That's what I use as a proxy for bonds, but I don't know if we're going to get that high before selling off. But again, I'm not expecting us to stay in this channel. And remember, bonds are a lot bigger market than stocks, so it's harder to tame them by algos. But algos trade bonds like there's no tomorrow because they have amazing liquidity. But I'm expecting us to break out of this environment right here sometimes next week. More likely than not, go lower. I'm probably going to miss this trade, but I'm only going to the short side because I want to stay with the main trend. Now, a lot of people are asking me about the energy market. Energy market is in fact vulnerable, but we're still in an inflationary environment. We are still in war. And last time I checked, we've seen these pullbacks happen all the time. In my opinion, energy is going to come back higher. And let me tell you why. Actually, let me look at this study here. Change this to 50. All right, here we go. I would wait for us to break the 50-day moving average, which on the XLE is right around the 88, 89 level, all right? Now, I think we're going to go back up, and I think we're going to go higher. And let me show you one of the reasons why. If you look at momentum levels, which we always do on this asset, you will see energy. You've got 61% of stocks trading above the 200-day moving average, but only 22% trading above the 50-day. That tells us that the foundation is still very, very strong. But on the swing side, let me just show you this. This is worth watching. You guys are going to love this. Here, let me just change this here. Okay, here we go. Up, down. Look at where we're at right now. So we could easily rally from here on, or we can go down a little more and rally. But we're not up here right now. We're all the way down here. And this is a chart going back 7 years. And what happens every time energy comes down? This is every time the energy comes down when energy is not in a crazy bull market like it is right now with Warren Buffett buying Oxy like it's going out of style, like it's steaks at his Omaha steakhouse. I had to say that. So I wouldn't be surprised if we either came down a little more or just cooled off our heels just a hair or started moving higher. But I like energy sector, and I'm going to start getting bullish again on energy. And this consolidation that we're seeing right here is just a consolidation, and it's a downside. This is very natural. I mean, look, we peaked out at 95. We went down to 85. It's not a big deal. We didn't go to 70. So I do think energies are going to be making a comeback. Now, in terms of sectors, guess what the number one sector is now again? What if I told you the number one sector right now is not industrial anymore like it was yesterday? What if I told you that the number one sector now is, again, energies? Energies is taking the first spot. That's right, the first spot. So even though it's not the best performer over the last 30 days, it's definitely not the worst performer. Energies are right here. And in the last several months, they've beaten everything hands down. So right now, energies now ahead of industrial. Again, focus on these sectors right here: energy, industrial, financial. I don't even know about financial, healthcare, and consumer staples. Those I like. The other ones I do not. Keep your eye on the bond market. And most importantly, keep your eye on the Fed report. If this report is above 200,000, 220, 230, then it's going to be a presupposition or an implication that the Fed can, in fact, that the economy can stand more heat from the Fed. And what you're going to see is you're going to see this number right here, the 50 basis point, increase to 50%. I think it's going to happen, actually. So we will see. Keep your eye on the market. Remember, we're still consolidating like there's no tomorrow, and wait for a breakout or a breakdown before you make major moves. I believe we're going to break down, but we'll see what happens. Now, my newest strategy, folks, it may be the best one yet. Today, I'm going live. That's right. Today, I'm going live at 1:30, right after Ask the Pros Elite, to break down how it works, give you the inside scoop on some of the small caps that I'm looking at right now. Now, why small caps? Because that's what the strategy is laser focused on. Now, I expect generational opportunity in these smaller names. I've been telling you guys forever that small cap stocks peaked out. Look at this. Small cap stocks peaked out about a year, I tell you. Look at this, a year before the rest of the market. This is when the stock market peaked out. This is when small caps peaked out. And they're already consolidating. And when they break out, they're going to break out. And I'm expecting a generational opportunity. It doesn't use fundamentals. It doesn't use technical indicators. I know, I love technical indicators. It doesn't use them. Instead, it focuses on a handful, 7 to be exact, price patterns. And we tried to make them better, and we couldn't. You've got to follow the link below. You've got to check it out, and you got to do it right now. Don't delay, and remember, I love you guys. I want to answer you and help you as best as I can. In the YouTube channel, we have a Wealth Press channel. That's where we post these videos. Post comments there, and I will respond to them ASAP. All right? Have a great weekend. Send me emails, support@marketgeeks.com. I've got you guys covered. Bye. And follow the link below. Check out my Code Breaker class today at 1:30 p.m. You guys are going to love it. I'll give you 3 ticker symbols, 3 brand new ticker symbols for my Monday's watch list. How about that? Pretty cool, right? Bye, guys. Take care and have a great, great, great weekend.